I can't see
Anyway,
that, but
good. All right, then I'm not moving.
yeah. Well, and I told you my house, like I've been away for a couple days and I came back and, my tub is in the front yard. So I'm like, okay, well, you promised me that by the end of the day, I'll be able to have a shower. And I thought, well, thank goodness I haven't been here the whole time because it was
Oh, yeah.
a
Where did you go?
disaster. Sorry.
Where were you? Where'd you go
Oh, I
visit?
just went up to New Hampshire for a couple of days.
Oh,
Get
wonderful.
away, and I have a place up there. So I just, had to escape the madness here.
Oh, I know. I love New Hampshire. I could live there, and I could live there in a heartbeat. My kids are like, "But Mom, why are you going further north?"
Yeah.
I love it there. I could, but it is too far away because my daughter and son-in-law, my two grandkids live in Seekonk, and it's just normally an hour and 15-minute ride in good traffic, but it can take 2.5 to 3 hours.
Yeah.
So it really would be foolish for me to go further north. I'd never see them.
Yeah, that's the sad thing.
Yeah. So do you want to, now how are we going to do this? Are you just we're going to open up and chat? Like, what do you want to do?
Yeah. So what I normally do is I add an intro, where I will introduce you a little bit more formally and stuff like that. And I'll add that in afterwards.
Okay.
Looking at your bio and stuff, unless you want to tell me exactly what you want me to say right now.
No, do whatever you want. Just a little thing. I've been in this industry in New England since 2000. I think my designation is important, a certified exchange specialist, because what is that? Like, I think the designation is important because this is all I do every single day. I'm not in court. I'm not doing people's tax returns. Right. I'm not working at the mall, or anything like that. And this is not a hobby, nor is it for the company. So asset preservation is well recognized nationally. And our parent company is Stewart Title. So we're well capitalized. Stewart's been around for 120 years, and asset preservation's been part of Stewart for 30. So I think the recognition, because the qualified intermediary industry is not regulated.
Yeah. So just anybody can hang a shingle and say, sure, I'll hold your money while you do this 1031 exchange.
Yeah, so it's very important. So be careful of when somebody says, oh, I know somebody that does that. There's a guy down the hall. That all may be fine, but you don't know. So it's really important to know who you're working with. It's not something that could just be given up arbitrarily to some company you find on the internet. So without finding out more about them.
Yeah, definitely. Interesting. It seems that it would be an industry that would be important to regulate, but I guess so much do I know, huh?
No, but the tax code's 100 years old next year.
Wow.
So it was codified in 1921, but it's actually the first exchange was in 1918. So it's not new. It's just that changes to how 1031s were done changed in 1979. Just a little background. So as you're thinking of questions, in 1979 with the Starker case, and that's when we got the expanded timeline. And then there's been tweaks over the years as I'll just tell you, but as the treasuries needed money. So they've made a few tweaks to sort of narrow, but I call it an equal opportunity tax code, because everybody from the single investor that just may own that, that chunk of dirt they've held forever, or that multifamily property that's their only investment they have, or a qualifying vacation rental. If it's not your primary residence, then what is it? If it fits into that description that we're going to talk about for 1031 exchange, then there's a chance that to stay invested in real estate, they get to use the tax code just like Jeff Bezos would on his Amazon warehouses. Or Walmart could do. Well, those companies don't really even own their own real estate anymore.
Yeah,
that's
right,
why they can expand. Yeah. So let's talk about, or a lot of Delaware statutory trusts. That's predominantly what they're using, is not so much REITs. I think you find REITs more in the hotel industry or the big, huge office towers.
Yeah.
But I'm seeing a lot more. I'm seeing Amazon warehouse as far as being in the DST realm, because you can get a lot of 1031 investors. Yeah. So I know a company that's got them, by the way. So anyway, let's see. Who could we use? Just say a large corporation that employs, maybe an Avalon Community. That's a good example if we're talking about real estate. Yeah. Maybe an Avalon Community would be one that they buy and hold their own properties. So I think that might make sense.
So let's start at the beginning and tell me what exactly is a 1031 exchange.
All right, well, 1031 exchange is a tax code election, IRC section 1031, that allows investment property owners of investment real estate to be able to defer the taxes on the capital gain that would be due upon the sale normally. Through an exchange, you're able to get out of that property that you no longer want for many reasons, like you don't want that property any longer, or you want a different asset class qualifies under investment real estate, or you're relocating. It allows you to get out of that and get into another piece of investment real estate. But on the sale, you would normally pay those capital gains taxes. This time you don't. Through the exchange process, you're able to invest into that other property using your proceeds from the sale, which is going to include those tax dollars that you would normally pay the federal and state governments.
So how long am I able to defer that tax?
Could be indefinitely. You can exchange throughout the course of your lifetime, and you may not ever have to pay those. If there's no sale, there's no tax. So if you keep investing, then there's no taxes due. But if you decide you want to cash out, you are paying back to the beginning. You could also do a partial cash out and only pay some tax. So it can be, those capital gains taxes can be eliminated by either passing away or not selling. So basically what happens is your heirs could get that property to step up in basis, the tax deferment goes away. And that would be for like the individual investor. If you are own property as a business entity, then that's going to be something that'll be worked out. But there's just you don't have to pay the taxes unless there's a cash out.
So it's almost like all the sales that you did in between are really transfers. They're not considered sales.
No, they're exchanges.
Exchange, yeah, sorry.
That's
I should use the lingo, the right lingo.
They're exchanges. You're getting out of one asset, and you're using your profit and that tax money into the next set of asset or assets, as long as they're in the real estate classification category.
Okay, so people who are now, somebody had told me that that you could take money from a Reit and put it into, or vice versa, you could sell your apartment building and do a 1031 exchange into a Reit.
No, not a real estate investment trust. That's a stock. One of the categories that are not exchangeable, even though it owns real estate, would be the Reit, because it's a stock. Okay, yeah. So stocks, bonds, and notes are not exchangeable, but there is a type of property called a Delaware statutory trust. They're Reit quality properties for the most part, if you're getting them from the ones that are governed by the SEC, or even other properties that have those Delaware statutory trust vehicles. They're quality institutional grade properties. So, but they're in the Delaware statutory trust, which are eligible for 1031 exchange.
Okay. So do I need to know ahead of time that I'm going to be, so I sold a place, like a month ago. Can I say, oh, you know what? I wish I hadn't taken the money. I really wanted to do a 1031 exchange. Can I now do that?
No, 1031 exchanges need to be set up prior to the sale. I can, as a qualified intermediary, we can save a deal at the closing table, but what if everybody's willing to go have a cup of coffee or sit and check their phone messages or scroll Facebook, right? So if you're willing to wait just a little bit, we can get documents out to the table. That's not ideal, because here's the thing. You're taking a tax election on a real estate transaction. So your real estate transaction is just going to be just that. The tax election puts a different cast over it, meaning that you do have a timeline that you have to perform in. So basically, for example, the exchange has to be set up prior to the close of sale. At the closing of the sale, the qualified intermediary is going to receive your money. You have an extended timeline to be able to, by which you need to be able to purchase and close on the replacement property. And within that, and it's a 180-day period, including weekends and holidays. So, and then within that 180-day timeline, you've got a 45-day identification period. So there's a notice that the qualified intermediary will send out upon receipt of funds. There's a set of identification rules, and by midnight of the 45th calendar day, your identification notice needs to be received by the qualified intermediary as to what you intend to purchase. Now, that said, you can also close on your replacement property within that 45-day window too. That's fine. You're able to buy multiple properties as well. So There's rules about all of that. But I guess the main point, Christine, is that the timeline starts the date you close your sale. However, as in a real estate transaction, you're negotiating what you want to buy and looking possibly while you're waiting to get your property sold, just like in any other transaction. You just want to close have the closing for your relinquished property sale first, and then close on your replacement property after.
So I have to identify up to 3 properties that I want to purchase. But what happens if for some reason I'm not able to actually buy one of those 3 properties?
Okay, well, first of all, you don't have to identify 3 under the 3 property rule. You could identify up to 3 with the intention to buy 1, 2, or all 3. Here's one thing people need to keep in mind. For a full tax deferral, you need to be purchasing replacement property or properties that total an equal or greater value than the property you sold, minus your allowable costs of sale, which there's about 4 of those. So equal or greater than that net sales price. We're talking about the value. So the value is that contract price for which someone's agreeing to buy your property from you for, okay? And then minus the allowable cost of sale. So you can do that under the 3 property rule by identifying 1, 2, or 3 properties to reach that goal. So let's just say, though, that you've been out looking and you just can't find anything. You set up the exchange, Qualified Intermediary has your money, day 45 is approaching, and you're like, you know what, Christine, I can't find anything to buy. I'm assuming you're my real estate agent. So day 45, I just can't find anything. You know what, I just stop looking. I don't want to continue with the exchange. Don't identify. Call the Qualified Intermediary. There's forms you have to fill out, but day 46, they can release your funds. However, if you do identify, the QI has to retain your funds for the remainder of the 180-day period. And if you don't close on that property, you can request them back day 181. In either scenario, you just pay your taxes like usual. The QI will retain their fee because we're a fee for service.
It's not their fault.
Yeah. So, but they don't come take your kids. They don't come, they don't come do anything. They don't come and pick up your dog. The point being is that you're simply just going to go and pay your taxes on your next tax return as if you never set up the exchange.
Right. Okay.
Okay. So it is a mechanism to allow you. So at that point in time, basically you've paid for the option to be able to do the exchange.
But but you can't now say, oh, I actually found a 4th property that I like. It's just like, it's too bad at that point.
Not after day 45.
Yeah.
Up to day 45, say, for example, you close on June 1st, okay? You send in an ID notice on July 20th. I mean, I'm assuming your 45th day at this point would be July 15th. So June 20th, you send an identification notice, but 10 days later you go, I don't like that property that I identified. I don't want to buy it because I found one I like better. Yeah. You rescind the original identification notice to the Qualified Intermediary. Just let them, you just rescind it via a signed, scanned email attachment. Just say, I rescind my previous identification notice dated such and such, and I want to replace it with this one. Mm-hmm. Send in a new ID. Here's why. Because there's different property rules that you get to choose to identify under. The first one's the 3 property rule. The second 2 allow you to identify 4 or more properties, but you have to fit within those guidelines. So say, for example, you've identified 3 properties on one, but now you're going to change them all. Now you've identified 6 if you just send in a new ID notice with 3 new properties. So you do need to rescind the first one because you could totally screw up your exchange. Your Qualified Intermediary is here to have those conversations with you as the investor. That's the role I speak to you from today as the Qualified Intermediary.
Yeah, it seems like there's a lot to it. You don't want to try this don't try this at home, kids.
No, you just need to have a knowledgeable Qualified Intermediary and knowledgeable tax a tax consultant like a CPA accountant that's willing to work in conjunction with the Qualified Intermediary.
Yeah.
So
why is this such a valuable tool for investors?
It's really one of the last big ones left. When you see the amount of capital gains taxes that could be due on your sale, for example, in the state of Massachusetts, here's what you got going. We've got first of all, you've got the depreciation recapture tax. There's 4 taxes that comprise capital gains taxation. First one's depreciation recapture. So you get tax credits called depreciation during the amount of years you own the property. For residential real estate rentals, for example, it's 27.5 years. For commercial property, it's 39. So say you've owned a property for 10 years, you've probably taken 10 years worth of depreciation, not just on the building itself, but any capital improvements you've made, which would start the year that you start reporting those on your taxes too. That tax is a flat tax of 25% on the value of depreciation you've taken, okay? Then you've got the federal capital gains tax, which is based on income, and it's either 15 or 20%. It's your capital gain minus the value of depreciation times either 15 or 20, based on which tax bracket you're in for capital gains. Then you have the net investment income tax, which was part of the Affordable Care Act, which came out in 2013. It's now called the net investment income tax. And that's 3.8 on the gain minus the depreciation times the 3.8. And then in the state, and those three taxes are federal. Then we have the state capital gains tax from Massachusetts, which is on the entire gain, which is it's somewhere between 5.1 and 5.2. I usually have people calculate at 5.2 because, it's a fraction there, so you can get a better feed. We actually have that capital gains calculator on the Asset Preservation Inc. website. So if people want to go to www.apiexchange.com, go to the 1031 resources, and then just scroll down till you see the capital gains calculator. There's a way that you can work a lot of your numbers through to find out. So it's going to ask you questions. You just fill in the blanks, and it'll give you an estimate. As always, investors should go take that information and consult with their CPA or tax advisor to make sure that they've done it properly. So it's a good guesstimate when you can't sleep at night, and then go talk to your tax advisor.
All right, great. And we'll also put a link to that calculator on getyourfillpodcast.com. So folks, if they're already, listening from there, they can just click the link and go right to that calculator.
Sure.
So I feel like I am starting to understand how it all works, but let's do an example of how, like if I were just a small investor. Let's say I'm a small investor, and like you were saying before about selling a vacation property. So how does that work? If I just want to sell one vacation property and buy a different one in another area, how could that work within the 1031 exchange framework?
Well, it can for several factors. So as the QI, if you were my client and you were coming to me with that scenario, I have a list of questions I usually ask. But the first thing is to find out if your vacation home is actually a qualifying vacation home that would be deemed investment, as opposed to a second home. Because I'm just going to coin a phrase, but the IRS, they're a bunch of friendly people. I've had to call them before for things personally. So everyone's been really wonderful, but they are collecting taxes. So they have a job to do. So the point being is that the IRS as a whole will allow you to have a little bit of fun, but not too much. So there is a difference between a qualifying vacation property for investment purposes and a vacation home where you're overusing it, having a little too much fun, and it's really going to be a second home. Second homes, for the most part, are going to get taxed. It's not your primary residence, for which you have the Section 121 exemption for, and it may not qualify under Section 1031, where you get the tax deferment for by buying other investment quality property, or investment grade property. So that said, let's talk about your vacation home. Let's assume it qualifies. So, which would mean that in the 24-month period prior to your sale, divided into two 12-month periods, you've used that property a minimum of 14 days personally, because you do get to do it, or less than 10% of the rental time, you get whatever's greater. So, let's just take a look at your two 12-month periods. Did you use it 14 days or less than 10% of the time? And those days don't have to be consecutive. Was it available for rent when it wasn't rented between your personal use time and the requirements that for the last 24-month period divided into two 12 months, they don't mean 2 years, they mean two 12-month periods. Was it rented a minimum of 14 days each of the two 12-month periods? Doesn't have to be consecutive, income reported on your tax returns, and all like that. It needs to look like investment property. And then when it's not being used by you during the qualified use time, Or the qualified investment rental time, it just basically sat empty, available for rent. Okay, so if you meet those requirements, it can qualify. So then I'm going to ask you, so how much are you selling the property for? You're going to give me a figure. And again, we're going to talk about what you want to buy. Do you plan on holding this out as qualifying vacation property? As QI would supply the guidance to you. You're going to discuss with your CPA to see how they want your records kept. Okay. And so that said, if you say yes and it meets the requirements, then fine. You can relocate to into a vacation rental anywhere in the United States.
So if I knew I were going to if I knew I were going to want to do this, I would really have to make it, so it has to have been rented at least 14 days.
Each of the two 12-month periods, income declared at fair market rent on your tax returns.
And if it was like quote unquote available for rent, but no one actually happened to be there, and I did go in and use it, I mean, I'm not trying to like create a scam here. I'm just wondering what, I'm actually thinking about a property that I own where, I might have been up there for more than 2 weeks, but it was available for rent, and I just went up because no one else was renting it.
Well, that's a conversation to have with your CPA,
Mm-hmm.
because I can't speak to that. But I don't know what they ask if you were ever audited. Are they looking at electric bills? Are they looking at, what are they looking for? We don't know that Hansel and Gretel breadcrumbs that we might be leaving. So the point being is, I would ask you too, were you doing actual maintenance work yourself? Were you doing, were you doing those things? And ask your CPA if there's any of that time that could be qualified as maintenance and repair work. Right. Do you have receipts? Do you have those conversations? Because it's not my role as a qualified intermediary to ask you that, just to simply look for red flags to see, okay, in this section you're qualifying, but now you're telling me you stayed there more than the 14 days. Mm-hmm. Well, what was going on while you were there? Were you out sunning on the deck, or were you actually doing repair work?
Right, right.
They're not going to allow you an extra day, an extra week because you painted a bathroom.
Right.
Okay, so you want to have that conversation with your CPA to make sure that you haven't overused the property personally.
Okay, interesting. So now, how has COVID affected this 1031 exchange?
Well, there was an extension issued by the IRS for a specific category of people. For example, if you currently have an investment property that is closed between April 1st of 2020 and May 31st of 2020, you're going to get an extension through IRS notice 2020-23 that is specifically for COVID-19, which is going to extend your 45-day identification timeline to July 15th. Mm-hmm. Okay? So if you closed on March 31st, or if you're closing on June 1st, the extension's not going to apply to you. It also applies to people who had year-end closings and beginning of the year, and or whose 45-day identification period was between April 1st and May 31st, or their 180-day deadline was between those time frames. Both of those scenarios are going to get the extension to July 15th as well.
Yeah, because it's definitely been difficult to look at properties
Well, and I think that's what they were taking into consideration, because during this pandemic time, when there were restrictions, people weren't going to be able to freely move about. But as restrictions are starting to ease up, and in some states, real estate was deemed an essential business, there were ways to work around it. So what happens in our role as the qualified intermediary? So anybody that's within these guidelines, as we were that had the timelines that went into those period, the April 1st to May 31st, we notified them. Okay, but for anybody that's closing with those in those timelines, now we are sending out, along with their identification notice, the IRS guidance. People are automatically getting these extensions.
Yeah.
Okay. Good. Now, can I add one more thing? If they choose not to take that the identification timeline extension, and they want to stick to their 45 days and they're not going to continue the exchange, they need to notify the qualified intermediary by midnight of the 45th calendar day of their ID period that they are not going to continue.
Yeah.
Okay. But I don't know, personally, I don't know why most people, if they really want to stay invested, wouldn't just wait out the extension, because you know what Murphy's Law is like, something might drop in your lap and you can't go back and reset it back up. But
Right.
some people may have a real financial need, so that's a benefit for them.
Yeah,
So
exactly. That's true. That's true. Yeah, especially now where so much craziness is
yeah,
happening for
because you don't
folks
know,
who
we don't
can't
know what we
work
don't
and
know
stuff.
yet. So, but it
Yeah.
might, benefit some people that they may need the money. And so this does give them, but they're the ones that have to make the call and say, okay, I'm not going to continue this. And they need to do it by day 45
Yeah.
of their original timeline.
So as far as things being considered like property, I mean, how general is that? Could I buy land after selling a condo? Or, I mean, how?
Yes, yes, you can. The like kind real estate has always been the most broad asset class. And it's the only one that's eligible now for 1031 exchanges since the tax reform bill a couple years back. So it's anything that's classified as real estate under that real property asset class. So we look at that federally, because realize Section 1031 is a federal tax code, and all states but Pennsylvania recognize it at the state level. Pennsylvania is the only state that doesn't recognize Section 1031 for state tax purposes. Okay, but federally it's recognized. So that said, you also then have to look at what a state deems real property. For example, I recently did, what was last year, I did an air rights exchange for air rights on a Brooklyn, New York property. The person sold those air rights and purchased a multifamily rental building in Jamaica Plain.
Wow.
So that qualifies. So one would need to check and be sure that air rights are considered real property in their state, for example. But there's things like cell phone tower easements. There's some unusual things that people just don't think of that are real property. Most people are thinking of the normal things like multifamily rental units, single family rentals, retail, a chunk of dirt, all kinds of things. And one of the things, Christine, I always like to touch on when we're dealing with properties, specifically in Massachusetts, around some of our cities and towns, we have a ton of multifamily properties, 2 to 4 units. And then when you get over 5 units, or 5 and more units, when you're getting into 5 to 10, even greater. But we have a lot of those properties. Many times, and I know I love this topic, but many times the owner occupies one of the units. So if I was an investor, let's just say you, because I'm the QI, if you were the investor and you lived in an owner-occupied 4-family property,
Mm-hmm.
let's just say due to the appreciation value, and these are still hot commodities around this marketplace,
Yes.
let's just say you're going to sell it now for $1 million. I'm going to ask you as the investor, okay, so how are you claiming these units? Meaning, what percentage of the properties, like the size of each unit, or is it like you live in 25% of the building, or the units all the same size to where you have everything's 25% of that total value, usually determined by your CPA by the square footage on the property. Okay, because let me segue a minute. Sometimes I'm dealing with owner-occupied twos, even if they're not, an owner-occupied two, where it's a bottom level and a top level, but that top level actually has 2 floors. So 40% of the building on the bottom is a unit, and then the top 2 floors represent 60%. So I'm looking at those figures too. So that's why I ask those questions. But in your situation, it's an owner-occupied, for example, you live in a unit that's 25% of the space, the other 3 units total 75% or 3/4. Now we're going to look at the sales price of the property you're selling for $1 million. So the 3 units that are rental comprise $750,000 of that building that's eligible under Section 1031 because they've been held out for rental. The other 25% of the building, so you've lived there and you meet the requirements of having lived there 2 years out of 5, which PS, by the way, CPAs actually look at it as 24 months out of 60. Just so you know. So you've lived there 2 years out of 5. You're going to get that primary residence exemption since you qualify. Say you've owned the building 5 years. You're going to be able to, and you've lived there, you're going to be able to take that exemption on the value of the capital gain on that unit. But then the rest is exposed for taxation if you don't sell or if you don't exchange. So you're going to do an exchange and look for other replacement property for $750,000 net 3/4 of the allowable cost of sale. Okay, so you don't have to go buy another owner-occupied property unless you want to.
And how about if my kids lived in one of the units? Is that
Are,
just get
are you
messy?
charging them fair market rent?
Yeah, probably not.
So I'm going to send you to your CPA and say, just ask your CPA about it. How much rent were you charging them? If it's no rent, you might have a problem. But I have had situations where some of my clients have had their child in there, but the child is on SSI. They have a disability.
Mm-hmm.
So we're going to take a look at that. I'm going to say, talk to your CPA about it. If there are any factors where they could stand behind under fair market rent, you'd really need to prove it. And I have had some situations where it's worked out that way. But for the most part, if you're renting to family members, you need to be charging in the range of fair market rent, not taking a loss. But every exchange, every scenario is a snowflake unto itself. And so I am not the one that determines that. The CPA does, because they've got your entire tax record and reasons why.
Yeah. So it really is going to go back to the type of the way that it's all been recorded in your taxes in previous years. Yeah.
That's what tells your story. This is a tax election on a real estate transaction. So what's your tax history? What's your tax reporting history like? Does it support what you're trying to do? There's a lot of factors involved, not just the fact, well, I held it out as rental. There's more factors when you start bringing in your life story. And this is one of the great things that I do love about this tax code is there's some wiggle room.
Yeah.
It's not, there's some things that are set in stone, like your timelines, like when it needs to be set up, things like that. Like you can't leave a closing and call the qualified intermediary a day later and say, I didn't cash the check, can I do an exchange? No, it has to be set up prior to the sale. So there's some bases that you have to tag, right, that are set in stone. But there's some gray area out there, which is life. And so based on your circumstances, I'm not going to be the one to say, no, you can't do it unless you're trying to exchange your primary residence because you only live there a year.
Yeah. Yeah.
And you're thinking you can have a tax advantage through 1031. No, you can't. You live there and it was not property that you've held for productive use in trade or business or for investment purposes. Okay. Or had the intent to do it, but something happened.
Yeah.
Okay. So there's going to be a list of questions I'm going to ask you so that you can then go talk to your CPA or tax advisor about it.
Now, you bring up a point when you were just saying, is there an amount of time I have to have held this property before I go off and do a 1031 exchange?
Well, there's nothing set in stone as far as how long to hold a property, and that's when it becomes based on intent. Yeah. But there are a couple sections of the tax code that actually give some holding requirements as it pertains to a 1031. The first one you and I just addressed, vacation home guidance. I talked about a 24-month period.
Right.
Not necessarily meaning 2 years. It could be 3 tax years. Every time the calendar changes is a new tax year.
Right. And
depending on where that 24-month period started, could be 3 tax years.
Right.
But two 12-month periods, 24 months.
Right.
So let's just say you can take a long-term capital gain in 12 months' time. It could be an aggressive approach based on what's going on. The IRS has many factors that they look at. Okay. And then you have the related party section of the tax code where if you were my sister and we swapped investment properties, they are investment, we have to hold our properties for 2 years. So is that 2 tax years or is it a 24-month period? CPA is going to answer that question. But it says 2 years in the tax code where we have to hold them. We can't do another exchange. We can't move into them. We can't change the use of the property at all. It has to be held that way. Now, then we know that we do know that if you're audited, the IRS could ask you for up to 3 years worth of tax returns. So how long to hold a property is somewhere within that range based on your facts and circumstances. To be able to qualify under Section 1031, longer time is less risky. So I'm going to defer that back to the CPA. So one of the big questions the elephant in the room is, what happens if it's under 12 months? Which is when you can take a long-term capital gain. We need to look at the circumstances. If you purchase a property and you've just spent your time fixing it up and now you're going to sell it, probably a fix and flip, it's going to be considered property held for sale. But is there something that, did you try to rent out that property and you were unsuccessful? Do you have proof? What does your CPA say? Did you get relocated as you were trying to get tenants? All of a sudden you have another job and they want to send you to California and they're requesting that you be there in 2 months for a job. You know, these are things that we're going to say, okay, what was your fact pattern? Why do you need to sell this property in under 12 months' time? And would your CPA stand behind the 1031 tax code if you were ever audited and say it's a legitimate exchange? That's not my job.
Right. No, interesting, because I actually have a client who had bought a property with the intention of fixing it up. Sorry, there's construction going on behind. Uh-oh, we better wrap up here. He had actually bought a property with the intention of renting it. And then, of course, all this drama happened. And, you know, he thought, well, maybe it'll be better for me just go ahead and, you know, and sell it now. But he hasn't advertised it really or anything. He's just thinking about the logistics of renting now.
Well, after this, let me just, if you'll shoot me a quick email, I will send you property held for sale, how long to hold, and what doesn't qualify. Fix and flips don't qualify under Section 1031. They don't. Now, I've had people fix, they were gonna flip, but they didn't and held it out for rental income. I'm working on an exchange that closes today. So she did hold it for a period of years after. So that's now a rental property, okay? I've had people that are fixing, they're flipping, but they have no proof that they were going to attempt to rent it or anything else. What's your backup? What's your story? General fix and flips, no, it usually qualifies under property held for sale, but you can change your mind while you're doing it. Maybe you have had some activity that you were showing that you attempted to rent it and couldn't, and now you have a financial issue. We're going to walk through that. I'm going to talk about the fact pattern with you. I'm going to send you property held for sale, how long to hold, and what doesn't qualify, and send you to your CPA, okay, to say, look at what they're asking for, what shows that something's property held for sale against your activities. What do your activities showing that you were doing? Because those are all taken into consideration. Something happened to your volume, Christine.
No, I know. I was muting because, you know, like I said, there's banging going on.
Oh, the hammering. Okay.
So when I wasn't actually speaking, I was muted and you had to mute my lips.
I thought you were, you know what? You must have been reading with your lips moving. Sorry about that.
No, I was saying things, but they weren't important enough for me to unmute, actually.
Nobody needs to listen, right? What else do you have for me today?
Well, Lynn, this has been really fantastic. So I want to ask you, you know, what did I fail to ask? What do you think new people just starting out thinking about doing a 1031 exchange, what do they need to know that I didn't ask you?
Well, how about if I just give you a summation? Okay.
That'd be perfect.
First of all, please remember the role I speak to you from today is of a qualified intermediary. A qualified intermediary is the non-related third party that you must use in a 1031 exchange. Our role is to produce documents to make it a 1031 exchange, and there's a role that we play in this process to make it happen, like produce documents. The investor cannot have control of their funds during the exchange timeline, the funds, and so we take care of all that according to the Treasury regulations. Now, for the investors themselves, investors need to know these things, that the property that they are trying to exchange or wish to exchange is property that is held for productive use in trade or business or for investment. So it's been held out for rental income, either residential or commercial or mixed use, or an owner occupied and rental property at the same time. You can use your primary residence exemption and then do an exchange on the rental units. A commercial, like say if you own a strip mall, okay, a chunk of dirt that you've held for appreciation, okay, those things, and different things like air rights, qualifying vacation property, Delaware statutory trust. There's a vast amount of things, property that you've held out to receive an income from, or run your own business out of it. So if you have an insurance agency and that's yours and you're the agent, you're running your business out of that property, can also qualify. So there's a whole bunch of things. So that's and once we go through the process to determine if you've held it for productive use in trade or business or for investment, then you can go forward with the exchange. You must be purchasing other investment property that fits into the real estate investment class category going forward. So it doesn't have to be a multifamily for another multifamily. It can be a multifamily for a small retail plaza or for an office condo that you're going to run your business out of. So again, there's quite a variety there. Tax ownership we didn't touch on is extremely important. The same tax ID number and the tax reporting method you've been using must remain constant for a period of time to have a tax history prior to the sale and the exchange. And then upon purchase, the replacement property and a period of time after. That's important, very, very important. And we would talk about that as I talk to taxpayers who want to exchange property and investors. And the other thing that people need to keep in mind, for a full deferral, you need to be buying other investment property that is equal or greater in value than the property you're selling, net the allowable costs of sale, and you can purchase a combination of one or multiple properties to achieve that goal. You can also do a partial exchange. A partial exchange to be able to buy for less than what you sold for, but if the capital gain exceeds the value of the property that you're, the reinvestment value, then there's nothing to exchange. There's a formula for that. I don't want to take up time going through all the details, but you can do a partial exchange if you are buying investment property that gives you some capital gain to defer. You'll defer taxes on that, and then you'll pay taxes on the difference. But there's a math calculation there that we need to discuss. And make sure you set the 1031 exchange up prior to the close of that sale. So you do need to make sure you have a reputable qualified intermediary, that you're working in conjunction with them and your tax advisor, making sure you list property with a real estate agent who knows a little bit something about it, but they cannot give you tax or legal advice either. And then everybody else will be the same player in your equation. But that's pretty much it. But start early in the process talking about the exchange with your agent, talk to a qualified intermediary and your CPA early in the transaction.
Excellent.
So if that's not enough to keep you busy.
No, that's fantastic, Lynn. My goodness. I can't imagine a more qualified intermediary than you.
Well, I love what I do. I have 20 years in the industry. I am a certified exchange specialist, which means, like you as a realtor, Christine, I've worked a number of years in the industry, sat for a 2.5-hour exam, and I maintain certified education credits every 2 years in order to keep that designation. So all I do all day long.
Excellent.
1031 exchange. Asset preservation is a well-recognized national qualified intermediary. We are owned by a title insurance company that's been in existence for 120 years. We are a subsidiary of that, and we've been in business for 30. All we do all day long is 1031 exchanges.
Beautiful.
So, sure. Thank you.
Lynn, thank you so much. This has been fantastic. I know a lot of people are going to be, I hope it's really opened some people's eyes as to what their opportunities are to defer taxes and to save some of their money for their investment instead of giving it away or sharing it with the government so they could send it to everybody in stimulus checks.
Well, absolutely. Once they see and they really understand the taxation on this, especially if they've owned this property for several years, how do you go earn that money back? Over a 20-year people, I have seen people, oh my gosh, some of my biggest deferrals were in the $1 million range. Like, where do you go earn that money back?
Right.
And it could be $25,000, $30,000 for somebody in taxes, but where do you go earn that money back? If you stay invested in real estate, you're able to use that to maintain and build your wealth through real estate. It's also an excellent estate planning tool, so that you can get property to your kids they would inherit it at the step up in basis. Your tax deferment goes away. So people planning to retire, there was ways to do that and have less management responsibilities, and yet keeping those dollars that they would normally write out to the federal and the state governments, they get to keep and use that money to
Yeah,
stay
that's huge.
invested. So
That's
it's
huge.
really, really great. Everybody, again, everybody's investment scenario is different. I welcome the phone calls if people will contact you. And then if they have a situation that looks like 1031 exchange should be a conversation we have,
Yeah.
and it may not be right for some people.
Yeah.
Please, I'm not billable by the hour. So we're a fee for service. So I welcome the questions
Fantastic.
and the contacts.
Excellent. Thank you so much. Yeah, your contact info, the information that we have, a transcript of the whole call or of our whole interview and stuff is all going to be on the website, getyourfillpodcast.com. So if you're listening to this on iTunes or Stitcher or whatever, just pop over to the website and you'll get the video of our conversation plus all this other great resources that Lynne's shared with us today.